Hello and welcome to the Investment Markets Podcast, where we aim to discuss investment matters that impact self-directed investors. I'm your host, Darren Connolly, CEO of Investment Markets, and with me today is Michael Fazzini from CapPru's. Today our focus is on investment opportunities within the property development sector. However, before we get into it, I need to remind you that this is all general advice and general information only, and nothing in this podcast should be construed as an investment recommendation. As always, you will need to decide what is right for you. Michael, welcome to the podcast.
Darren, thank you for the invitation.
Delighted to have you here, Michael. Now, to start, not everybody may know who CapPru's is. So before we get into the sort of the meat of the podcast, can you give us an introduction to CapPru's? The evolution of the business model, and generally what it does.
Yeah, thanks, Darren. Thanks for the question. So CapPru's, we used to be known as Capital Prudential. And then we had some whiz-bang marketing firms said, hey, why don't we shorten it to CapPru's? So
Capital Prudential was obviously just too long.
Too long. So CapPru's, the sort of formal new name. We started, but we were based in Adelaide 7 years ago when the firm started. We're now head office in Sydney, but the capability that we brought when the firm was created was around property and specifically property development. And there were three founders of the business, and their background was law, accounting, property management, and investment banking.
Yep.
So they figured, why don't we leverage our skill set and create a proposition for investors where property development drives the returns? Now, property development in this country is seen as quite romantic, and most investors, I would argue, at some point have sat around a table like this and discussed the prospect of buying an asset, a home, a piece of land, subdividing it, putting a couple up. Can we make it work?
Is that the great Australian dream?
It is. Well,
maybe it used to be.
It used to be, and hopefully we'll get back there one day. But so there's some sort of acceptance that property development in this country is not a concept that is unusual or out of reach. But what we wanted to do 7 years ago, we had two clear objectives. We wanted to make property development a little bit easier to access, and we wanted to make it an investable asset class. And I want to focus on investable as we work through this chat, because it's almost a no-brainer, but for an asset to be investable, there's an assumption that someone is aware of the risks and someone is managing the risks on behalf of the investor. So when it comes to accessibility, we're a wholesale-only manager. It's $100,000 or thereabout entry point. So that's quite accessible.
Yep.
But we sort of turned property development on its head a little bit, because when we started the business 7 years ago, even though we were generating profits in development, we weren't paying those profits to investors the way most investors are accustomed to, which is I put capital in a development. I don't quite know my rate of return. It's forecast, but I don't know it. And I don't quite know how long my capital will be tied up for. Again, it might be forecast, but I don't know.
You never know until you hit that end point.
And where there's that sort of uncertainty, then you could argue some investors may find that leap of faith a bit too hard to take. We sort of paired that with this demographic in Australia where we have an ageing population, and ageing population generally means what they're looking for is more yield than capital appreciation.
It's all about the income, Michael. I think we've seen that on our platform, particularly over the last few years.
I mean, two things about income. One is that it's reliable and it's real. Capital is, in a way, speculation. You don't quite know. But the fact that we knew there was a hunger for yield from an investor perspective, we wanted to deliver those attractive profits that are available within property development, but pay them off as a regular, predictable income stream where the initial capital invested was unmoved. And we created a notes program called the Secure Income Notes, which still exists. That's been running for over 7 years for direct investors. It's had a wonderful reception by investors who continue to support us in those types of structures. But because we wanted to grow the accessibility of what we do, we needed to convert those notes into a managed fund structure such that people like financial advisors can access through platforms. Investment Markets is a platform, and there's many other platforms. So we created a managed fund called the Income Opportunity Fund, which is essentially the same as a secured income notes, but structured as a unitized managed fund with a fixed unit price of 1 with regular monthly income. If you go forward from our journey 7 years ago to maybe 2 or 3 years ago, so that's 4 or 5 years into our journey, because our track record of paying what we said we will pay was a 100% ringing true.
Which is always good for the investor.
Very important to the investor, also very important for our reputation and brand, and good evidence that what we're doing seems to be working. But investors started to get more confidence in us, and therefore they started asking interesting questions like, I get a really good income return, but I don't really know what you make on those developments. I would like to make what you make. Is that possible? Of course it is. So what they're really asking is, can I become an equity investor in a development fund? So that's the more traditional property development opportunity. So we created these fixed series of development equity funds, closed 3 off. We're about to launch our 4th a little bit later this year, and 1 has now matured and paid out to investors. And whether you want to know how that went, maybe later on you can ask me how these things are going. But so that was the journey: make property development accessible, and the second thing, make it investable. Now this is where I spend a lot of time talking to investors around what type of developments we get into, how do we manage the many risks, because in property development there are many risks.
It is always about the risk, Michael. So how do you straddle that sort of world between the development itself and then having that investor hat on, standing in their shoes and understanding what they're worried about? How do you manage all of that and understand sort of and process the risks and make sure they don't escalate and all is good, all is under control?
Yeah, it's probably a more insightful question, Darren, than even you think it is, because I'll answer it specifically around risks. But you made the comment about property development, and then you've got like an investor hat on. We are a fund manager, not a property developer. Our capability is in property development. So when you're a fund manager versus a property developer, there's a couple of things that I think you more actively think about. One is risk, and I'll get to that. And the other one is governance. Because if you're a property developer and you're providing access to a cohort of investors into whatever development you're offering, they generally could be acquaintances, friends, but there's no real managing money on trust as much as a fund manager that has third parties that are investing that they may not even know they are. So things like independent boards, subcommittees that are independent, conflicts committee, something that you need to work very hard at. And
the governance becomes very, very important.
Absolutely. So I would argue we have institutional grade governance, but very boutique-y in terms of our offering. So we are a fund manager, so it's important to differentiate us versus a property development per se. Risk, it's all about risk. Now we are a build to sell property development-led funds management business. What that means is that whenever we do a development, we are not developing something for a long-term hold as a passive property owner. We want to extract the profits out of those developments, and that's what fuels all our investment vehicles and their returns.
And typically most of the upside, or a large proportion of the upside, can be realised in the early part of that asset life cycle. Is that a fair comment?
It's a fair comment. In fact, duration is really important. If you think about just in the world of investing, if you're forced to look out further in time versus shorter in time, without even knowing and caring about the asset class, I would argue, well, having the forecast further out in time is riskier because we don't quite know what might happen. The shorter the timeline or the duration, you compress risks. So we are a short duration manager, and I'll get to that by connecting all the dots. The type of developments that we target are the developments that generally only last with us 1 to 2 years. So they have a short life in our fund.
Can you give an example of those type of developments, just to tease that out a little bit more for people watching and listening?
So if you think about, we do both residential and commercial. I'll give you a commercial example. So it wouldn't be a major office a tower or a major shopping centre.
A lot longer.
They're things like medical centres, childcare centres, fast food, service stations, gyms, warehouses, particularly strata title warehouses that I do want to talk a little bit about, because I think there's a particularly interesting opportunity right now for those sorts of assets. Those assets are short duration. They're easy to build. 4 walls and a lid, so construction cost is also lower.
Yep.
But there's a ready market. See, the whole thing about being a build-to-sell manager, you need to be confident that there's a robust market willing to buy those developments, those finished assets, irrespective of the economic cycle, which means office and shopping centres become, in our world, problematic because you don't quite know whether the economic cycle is favouring those assets or not.
Particularly a few years down the line, if they're taking that much longer to build. Yeah. So where will we be?
If we have an economic slump, demand for floor space, etc. So we like assets that you can get out of fairly quickly, but you've got a natural buyer's market. So even if the economy is somewhat slower, we go to the doctor, we probably still, unfortunately, eat junk food. We fill our cars up. We go to the gym to try and work off the bad junk food that we've eaten.
Cyclical economy there, Michael.
So these are sort of assets that, and our history has shown that we can put those away fairly quickly. And there's also a really interesting buyer's market it's almost 50-50 between investors and owner-occupiers for those sorts of assets.
And are you I'm just sort of assuming here, but when you have that 1 to 2 year cycle on a development, you would nearly be having a buyer lined up by the time you're getting that shed or station or clinic out of the ground, surely.
Let's talk about that, because it's really important, isn't it, to make the asset attractive for sale. Let's just go back in terms of managing that whole risk spectrum, and then we'll pick up some of those concepts. So the size of the market in development can be important. We are what we call mid-scale property development-led funds management business, which means we target developments that might cost between 25 and 75 million as a total development cost. Now, that is too big for that mum and dad discussion around the table about doing a subdivision, but it's also a little bit small for the major institutions, and the major institutions do manage risk. So what that means is we're getting far less bidding for sites from the big end of town and the small end of town.
So there's a gap in the market?
There's a gap. And that gap in the mid-scale is quite a fragmented market, but very many opportunities, but risk isn't really a framework that's employed in that part of the market as well as it should be. So what we do is we target that market and bring that risk framework. So the starting point, Darren, is the size of the market.
Yep.
The next is the type of developments, and we've sort of touched on that. What you want is developments that are short duration but also have a robust buyer's market to minimise the risk of getting a poor price upon completion. So I mentioned what we do in commercial. In residential, we're the same. We like boutique apartments, call it no more than 4 or 5 floors, no more, and I'll touch on that in a moment, and townhomes. We don't like your big residential towers, and 2 reasons. One is construction costs above 4 or 5 floors escalate quite dramatically. And secondly, it's a lot of capital tied up in all those apartments, so it could lock up capital. So we avoid those sorts of, that's not us. We also, and when it comes to residential, we prefer infill, where there's no new land. We don't do urban sprawl developments. We even try and avoid mortgage built areas if we can. So for those who know who we are, or if they go on our website and they look at where we've done residential developments, and if they pick their city, because we're a national business with assets all through the country, they'll recognise some of the nice suburbs that we've developed in resi. So size of market, types of developments. Next point is so important. We do a lot of pre-risking before we expose any development to any investor. And again, this is something that I would argue a developer per se may not do as well as what we do, because we're managing risk on behalf of lots of investors.
So explain pre-risking, Michael. That might not be a term that is sort of forefront of people's minds.
but I'm hoping it's a concept once they hear it and they say, yes, I like the fact you do that. So we rarely go cash unconditional on a site that we find. And by the way, for those watching in Sydney, it's one reason why we haven't done a lot of developments in Sydney. The market dynamic there almost assumes you can go cash unconditional, but you cannot do pre-risk or de-risking if you're committing to a site. So we might put an option on a site with a vendor, and we've got a period of time now to de-risk. The starting point is get yourself a development approval, a DA, as we call it. Or if you haven't got one, make sure you have a high probability of knowing what you can get. Because without a development approval, you don't know what you can build, and therefore you can't work out maximum use of the site. And let me just say something here, Darren. The most profit in property development comes from buying the land well. Your risk framework should protect the profit by buying land well. So you've got to have a disciplined process to work out what price can I afford not to go above. And we do this price discovery by working backwards. So let's say we have a development site. We've got an option on it. We've got a DA, development approval. We know what we can build. We get an external valuer to tell us roughly what the finished product is worth, and let's call it an arbitrary figure, 100 million. Right. We then say, right, if we get 100 million for the finished asset, we need to pay a few people along the way. We have senior debt in our development, so we've got to pay the bank. We have a builder. We've got to pay the builder. Then we have investors. We have to pay the investor. Then we have CapPru's. We want to make a minimum return on cost. That gets built in. Guess what that spits out? A land value that you don't want to exceed to make all this work. If you go above that, then what happens is that chain, someone along the line could be disappointed. So we are very disciplined about the most important part of property development is buying the land well.
So you're working backwards
Yes,
effectively?
absolutely.
Yeah, and that sets a floor, I guess, or a ceiling in terms of what you might pay for the land.
It gives us confidence that this development can work at that price. So market value in our world isn't based on a transaction of a similar asset that just occurred, or it's not per square metre. We look at that. Market value in our world is what works in our model. That means sometimes we can do a deal with a vendor, sometimes we can't. But it's that discipline that our investors should be confident that the starting point of any development and the most important part of any development, buying the land well, is being done with risk in mind and being done appropriately. Now, we go further than that. So the option is still in play. We've done all that work. We've now got a good price that we know works and the vendor's happy with the price. We go a little bit further. We either do a few pre-sales, if they're townhomes or strata title warehouses. You sell a bit, you got to please the bank.
De-risks it a bit further.
De-risks further.
Yep.
And we get leasing in place. So it's much easier to sell an asset with a nice long-term lease. Generally, with our commercial assets, an ASX 100 top listed company would be a typical tenant. So we work hard at getting leasing done. If we get along the way and we can tick those boxes, the asset then comes into one of our investment funds, and only then are investors exposed. If we couldn't get it to work, whatever costs we've gone through, our balance sheet wears it. Investors never see a dollar of that.
One of the other risks, Michael, that we've heard about over the sort of last 6-12 months has particularly been around construction risk, input costs, in finding skilled labor. We have that particularly through COVID. Okay, maybe it's mitigated a little bit since then. How do you address that risk? I know you've got a much shorter turnaround time, which obviously helps, but it must be something you look at quite closely.
Builder failure is a big risk in development. I said earlier, there's many risks, and that is certainly one of them. So our starting point with builders is, over the years, we've built a panel of builders that we deal with, that we've gone to tender with. And with builders, they're interesting because you ask any builder, let's say it's a builder who's done many residential projects. If you ask any builder, can you do an industrial shed, or can you do some fast
I was just
food?
going to say yes.
Of course they can, and they can. But the real question is, can you do it as efficiently as someone who's cut their teeth on those type of assets? So we have a panel, and the benefit of that is you can rotate builders if there's issues, but also you can go to a builder that has a proven track record in building particular type of developments, because we're very specific in the area we get to. But we then also do things like, before we take them on, and again, this is where a property developer per se probably wouldn't do this. Our chief finance officer would do a 3-year financial assessment on the builder, look at their balance sheet, simple things like, have you been late in paying tax, or have you defaulted on suppliers?
So you're looking for some red flags in.
We're looking for red flags. Now, not all builders are that accommodating when they want to expose their balance sheet to you, but it's just part of the way that we operate. So we do what we can to sort of mitigate the risk, but the reality is there will be builder failure and there will be material cost increases. In fact, when we started, COVID hit probably a year into our business, so we were tested nice and early. So all it means is if you have an environment where the costs are, and we'll get to this a bit later because we are seeing land going up as well as construction costs, interest rates have risen. What it might mean is there's less developments that make sense. So we would be even more selective in the types of developments that we would take on. Because every development, we just look at the current environment, we might project ahead a couple of years, the life of the development, and build it into our model. And you get some periods where maybe there's more developments that make sense, and there's periods where less makes sense. And I think, Darren, right now we're in a period where it's harder to make developments through the country work relative to a few years ago. And I want to talk a bit later on a particular market in Brisbane where that's really pronounced because of this sort of pre-Olympic build-up that they're seeing.
Let's maybe sort of step back into that Brisbane market then. So you mentioned dislocation, and Brisbane, as we know, has got the Olympics coming up in a few years' time. Hasn't really started building for that yet. But what do you see is the exact dislocation in that market, and what's happening there?
So Brisbane is the fastest growing capital city in the country. It's tough when you mention the Olympics, which is in 2032. There's over 70 billion of committed infrastructure projects at both the federal and state level. We're seeing the demand for particularly industrial space in Brisbane just totally outstrip supply. And supply is constrained because it's hard to make new developments work. And this is because what we do, we see markets, I would argue, maybe slightly ahead of other, because that's our core business, trying to spot opportunities. So we're seeing that there will be this constrained supply. Now, when you've got a constrained supply, what does that mean for existing asset values? What does that mean for existing rents?
Generally positive.
Yes. So until existing assets start moving up in rent and therefore up in capital price, existing new developments won't work. There'll be a point in time where they cross. I can now justify a new development because the existing assets are telling me this is what I can make on this site. So Brisbane is now at the starting point of just struggling with this supply-demand imbalance. And we know this because in core industrial rents, the last 12 months ending June, rents have gone up 10% in Brisbane. And this is even before that Olympic sort of
hasn't ramped up
yet. So
I can tell you the stadium side is still green. There's no diggers.
It is your hometown.
It's my hometown, but my adopted hometown, I think, is the accent might give it away. But I can tell you most of the infrastructure build has not started. It is all in the future and coming.
So as a active manager, now, I said earlier that we were a build-to-sell manager, but because of our reach, our understanding of these markets, particularly industrial sheds, and I do want to explain why they're so popular and why they make a lot of sense, but our active management style has led us to a position where we now are looking at buying to sell as opposed to building to sell. So we've got two suburbs in really close to each other in south of Brisbane that is a core industrial market where we found these two assets where the replacement cost of similar assets are 40% above what we can buy these two strata title industrial shed assets, and where rents are circa 20% below current market. I'm not talking future current market. So as an active manager, our view is, we would normally have developed something like that for sale.
Yep.
Here's something where we can buy it.
Yep. It's already built and it's already there.
And all we need to do, and they've got short WALEs or weighted average lease expiry, so of about 1.6 years. So what we can do is immediately start getting rent, simply the market. We're not even talking about above market, because as of today, what is market today? In 2 years, market would have moved. So we get the rents up, that'll drag the capital value up, and then we would look to sell, say, 12 months before the Olympics starts in 31 and make it a 5-year term. And I know I'm getting specific here on this opportunity, but investors can expect to get something like a 6% yield through those rents, but a total return of circa 15% per annum, simply and through an asset that has to naturally grow. And with these tenants and in that Brisbane market, they really haven't got anywhere else to go. It isn't as if they can just pack up and move, particularly if you're these two, I think it's Richland and Archiefield. You would know the suburbs better than I.
Yep.
15 Ks from the city, close to the airport, close to the M3, close to the M5, close to the port of Brisbane.
Well, if
Perfect.
they're supply constrained, as a tenant, what do you do?
You
got
have
no
to be
choices.
prepared to go to market. But those tenants will actually start having a look to see what their premises should be paying for rent, and they'll probably work out, I've done okay, because the asset was owned by a very major institutional manager, and this was a non-core asset. So whether or not they, to an extent, may have ignored the rents, good luck to the current rent, but we can see it like you need to be to market. So for us, all we're doing is playing on a very obvious dynamic. But I did say that strata industrial warehouses are really popular. We've a great track record in delivering those.
You're creating a product, if I can put it that way, that is specifically set up to take advantage of some tailwinds and deliver to investor requirements. Is that a fair
Absolutely
summary?
fair. And in fact, I'm glad you triggered my memory on something, because one reason why we are a fund manager, not a property developer, is that we take our skill set and we try and produce an investment structure that might meet the needs of investors. So I mentioned when we started, we saw yield as important, but investors still want capital and they like owning an asset. And this is another way of leveraging, where we're giving investors through property development both yield and capital growth. But the asset has already been built. So it's it can satisfy a retiree, pre-retiree, where 6% income might be considered adequate, but also knowing that there's a 15%, or that's our target return, a total return per annum. So absolutely, we're expressing our capability in a fund that will house these two Brisbane industrial assets. And I think it's a pretty attractive proposition from a total return point of view as well as income.
Yeah, and as an active manager, I guess you get to pull all the levers that are available to you to deliver a value add return for the investors.
Absolutely. So it's what we do. So even on the existing assets, we might do a little bit of tidying up. We might even reconfigure it, the internals. We'll wait and see, but they're in decent shape already, and that is a value add. We also could mix the tenancy mix to maximise, again, because that's our core business. We know what tenants go really nicely together. So we would work on that. But the key driver will be raising those rents. Now, Colliers, amongst others, are saying that they believe the next 5 years, the Brisbane industrial market will grow rents between 4.5% per annum. So the outlook for rent is attractive, but yet the asset that we have are trading at a 20% discount to current market rents. So to us, it just seems that we should pivot to those opportunities on behalf of our investors, and that's precisely what we're doing right now.
That strategy, if you then extrapolate it forward over the next couple of years, is Southeast Queensland going to remain a focus? Is that your view, or are there other parts of the country that you think will be able to have a similar dynamic and be able to provide similar results for investors?
Southeast Queensland, I think, will continue to remain one of the more attractive markets. So we'll be scouring that ongoing. But because we have people on the ground in all the states, we will be looking at similar opportunities for new sites as well as potentially existing sites. So, but I think it's fair to say that, Brisbane, Southeast Queensland, there's a lot happening. That's undeniable. It's in concrete. You need to be playing that as a potential growth story for investors. And the fact that we do it in a very disciplined way, and even 5 years isn't really a very long commitment of capital. It's longer than a lot of our other funds, but we're not asking investors to take an extremely long-term view. the advantage of Southeast Queensland in Brisbane is that we all know what's happening in 32. So if you've got a timeline and you know what's building to 2032, even though the future is unknown, so there's always that leap of faith required, there's this big dynamic that is supporting particularly the demand for industrial floor space, which I think the statistic that I've seen is there'll be incremental growth over the next 5 years of between 150,000 to 300,000 square metres of new industrial floor space required.
Lovely. Thanks, Michael. Thank you for your insights today.
Thank you, Darren, and thank you for the invitation. It's been a pleasure.
Thank you, everyone, for listening and watching. I encourage you to follow or share on your channel of choice so that it makes a huge difference in helping people find us. And for more insights from experts like Michael, I had to search, find and compare hundreds of investment products all in the one place for free, including opportunities from CapPru. Please go to investmentmarkets.com.au.